This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Bert Dohmen, publisher of the very well-recognized Wellington Letter, who's hasn't been on in a while, but every time he's been here before, something dramatic occurred in the markets, and Bert, it seems this time it's no different.
Yes, somehow you picked the moment exactly right.
Last time it was China and what was happening with credit, and this time it's the U.S. markets. We will continue from session 1, already in progress. Corporations are not investing in capital expenditures. It's in free fall. Small businesses are not investing. Matter of fact, they're pulling back. So that's why the money velocity is falling, and everybody's looking for hyperinflation, which we may get, which is a currency event at some point. But right now, we have an absolute fear of investing, and by that I mean top line growth. All of the earnings today are bottom line, massaged games based on low interest rates and off-balance financing, in my opinion. Bert, how does that translate to these technical charts that you have?
Okay, let's take a look at the first one. You know, I was on CNBC Asia on I think it was March 23rd, and I said on there because they wanted to talk about the IPOs, the Chinese companies doing an IPO in New York. And I said, you know, it's going to be a race between Wall Street getting these IPOs out the door and the market caving in. And I said, you know, time is getting very, very short here. We're getting major sell signals right now. And what you want to do is don't look at the Dow Industrials. Don't look at the large cap stocks because they are highly manipulated. For the Dow, there are only 30 stocks. And these are big cap stocks, which means that most of those shares are locked up in portfolios and will never leave those portfolios. It doesn't take much to move those 30 stocks. But what you want to look at is the NASDAQ and the small cap stocks. That's where the market is, and they are looking extremely dangerous right now. And right after that, they started falling apart. And that's what this chart of the QQQ, which is the ETF for the NASDAQ, shows. And you can see here the arrows, starting in about mid-March, and then we had that point number 2, which is you can see the number 2. That was I think that was the 21st of March. We got a big key reversal day on that day. On that day, the S&P 500 actually made a new all-time high intraday, and then closed lower. That was a key reversal. We said that's it. You always need a major index like that to make a new intraday high and then not be able to keep it into the close. That is always what happens at a major top. It's a trap. It's a trap for the bulls. And of course, we've seen a collapse in the NASDAQ and the small cap stocks since that time.
We posted a number of analysis showing the cascading from very high risk, such as biotech, where you don't have projected earnings, all the way down to the generals of the market, the Dow, and the rate at which it was falling off. And we took it all the way down through the Dow and then the NASDAQ. And you could see the risk money just leaving the market has been leaving at an accelerating rate, the smart money going out of it, and the last to fall becomes the S&P and the 500. And it's just falling now. Just this week, it started to crack, but the signals have been there for at least 5 to 6 weeks now.
You know, in fact, in February, we have these 2 trading services. Average holding period is probably around 4 or 5 days for any position. And we said at that time, in February, we said, you know, we're now getting into the end phases of the rise, which means that all the speculative stocks are going to have major gains. We'll be able to make a lot of money as traders, but we have to be able to get out on a moment's notice, okay? And we said the stocks that will go up the fastest and the mostest are those which have no earnings. I said, let's focus on companies that have no earnings because they'll go up the fastest. And they did. We had gains 36%, 22%, 28% in just a few days' time, you know? Yeah, but we also got out in time. In fact, I said before, in our private portfolios, which is a long-term approach to investing, we got into, we sold everything on March 24th. So, which was an unusual move for us, but we do that when we expect a major downturn in the market.
How long will this continue, and have you got any support levels, Bert?
I think we're going to hit the first minor support early next week. There will be a bounce, but this market is looking very precarious. We had a webinar last November, and I showed a chart of, three peaks in a domed house, and
I have the chart up here now.
There you go. And this is beginning to look so precarious, so similar to what we had in 1929 and other times when that formation was very similar. And no prisoners are taken on the down move. It goes down. It accelerates to the downside. And if there is a little bounce, and I mean a little bounce, maybe 2 to 3 days, you're still long, you might want to think about getting out on that. At least I would. And then, it can be fast and furious on the way down.
So you see this continuing with obviously counter rallies through the rest of the year?
Yeah. The only, positive, and, I always try to play devil's advocate with myself. Seasonally, the last part of April, after April 15th, after the tax day, the market does have some strength. I would also expect a major stimulus program to be announced by Japan sometime late this month, because by now they must see that their big hike in the sales tax, which started on April 1st, is going to just force the economy to come to a screeching halt. So that means that they're going to announce an even bigger stimulus, because the last one stopped working in January. Okay, that last stimulus, which started about a year ago, was much bigger for the size of the economy than the one by the Federal Reserve over the last several years. So that is fizzled out now. The stock market has declined. The yen actually has strengthened instead of weakening, which is what they wanted. And so they have to announce an even bigger stimulus, which means basically they might say, we are going to buy all government bonds offered to us by any holder of government bonds, which means primarily the banks. And I think the banks are loaded up with about $900 billion with the dollars worth of governmental bonds in Japan. So they have to let people know, okay, there is a buyer for these bonds, because eventually interest rates will start rising in Japan. And if the yields on the long-term bonds in Japan go over 2%, that's the end. Those banks are going to be sitting on such huge losses in their bond portfolios, and people will start wondering about the viability of these banks. So the government has to prevent that. And I think a huge bond buying program like that might calm the situation a little bit further.
Also expecting, Bert, that you will see a quantitative easing equivalent program out of the ECB in Europe, probably in May or June, which will bring some excitement to the market. The taper program, I do a lot of work with Richard Duncan. Even though it's being brought down, there's still a fair bit of liquidity through June. But the second half, at the current rate, it's a serious short liquidity flows problem there, too.
Glad you mentioned that, because it's so important. You hear the analysts in the media, they're talking about, well, they're only reducing the stimulus by $10 billion a month, and it's a slow process, and it really shouldn't do anything. The one thing that we always learn in the markets, if you're an astute observer of the market, what is important is the delta, the change. If you have a big stimulus going into the markets month after month after month, $85 billion a month, and then suddenly it stops, and then it's being reduced, and then eventually it goes to zero, that is a huge delta, and delta changes the markets. That's the only thing that you can really count on in the markets. And if anybody that thinks that the tapering here is not going to have an adverse effect is kidding themselves. They haven't studied economic history.
Key messages you'd like to leave with our listeners?
Gordon, I would say this to people. Don't expect any strong trend to continue without interruption. You now have the major central banks intervening in the markets. In my opinion, they have been cooperating with the high-frequency trading industry in order to push the market higher over the last several years. And that is now going to stop because of the revelations of this book that Michael Lewis came out. Okay, so now HFT is going to be a lot more careful. But the central banks will try to prevent what happened in 2008. And so when everything start looking really precarious, you can expect a big rally out of the blue. So never get overextended on one side of the market. That's one piece of advice. Don't expect a new bull market high. I don't think it's going to happen. And I would say, any big rally should be used for selling short if you want to make some money over the next year.
I didn't know anybody was allowed to say that, but congratulations, Bert. That's why I love having you on, because our listeners really want to hear somebody who honestly, we can be wrong, but at least they want an honest assessment of what they see. We got a break. Thanks again, Bert. Can you just tell our listeners how they could find out more about your works and your writings?
We have a website. It's Dohmen Capital, DOHM as in Mary, EN as in Nancy, capital.com. I do have chart videos I put on YouTube. So you just go on YouTube and put my name in there, Bert Dohmen, and you will come up with these chart videos, which I do from time to time. You can see the one from March 24th, where the heading was Last Chance to Sell. And so go to Forbes.com. I post articles there once in a while. And I had an article in there earlier this year called The Most Reliable Indicator of a Market Top. And that was very popular. So there are a lot of things. Just Google my name once in a while and get one of our services. I would say, it doesn't make much difference to me if you do or not, but it'll certainly make a lot of difference to you.
Bert, always a pleasure, and we'll have you back again, because this year is going to be, they're always fascinating, but I think between now and the midterm elections in the fall, it's going to be a very interesting time in the markets.
Amazing. It will be an amazing year. And thank you very much for the opportunity, and I wish you and your listeners great success this year.
All the best, Bert. Talk to you.
All right. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.